Good afternoon, everybody. On behalf of CFA Society Ukraine, I'm happy to welcome you on our online event, Ukraine Macro Outlook, Public and Private Sector Perspectives. My name is Nataliia Shpygotska. I'm president of CFA Society Ukraine and deputy head of research at Dragon Capital, and it is my pleasure to moderate our discussion today. I would like to introduce our speakers for today. Please welcome Konstantin Fastovets, Head of Analytic Department at Adamant Capital. Also, please welcome Yurii Gaidai, Senior Economist at Center for Economic Strategies, and also Vitaliy Vavryshchuk, Head of Macroeconomic Research at ICU. And hopefully, we will also be able to welcome a little bit later today, Volodymyr Lepushynskyi, Director of Monetary Policy and Economic Analysis Department at National Bank of Ukraine. So our today's event would be dedicated to Ukraine's macroeconomic outlook, and not only outlook, but also the challenges we are all facing while trying to analyze and forecast economic performance of Ukraine. And basically, this is the first question I would like to ask our speakers. Given all the uncertainty we've been facing for more than a year, given lack of any data available to be scrutinized, how did you adjusted your approach towards analyzing and developing your macro outlook, based on what you experienced last year, and how your approach have evolved already this year while trying to make your projections for 2023? So, Konstantin, if you don't mind, let's start with you. So, sure. How last year was for you? And
yeah, I mean, last year was, super difficult because obviously, not only was there really low, clarity with regard to, where the war was going to be, right? Because, I mean, when the war started, the military events looked one way, and then suddenly they started to look a different way. And it was really very difficult to say, where we would end up. And that had a huge impact on, any sort of forecast you were doing. Obviously, the other thing, as you mentioned, is that a lot of data wasn't published, right? So the Ukrainian Statistics Committee stopped publishing most of its data. The only really reliable source of data that we still had was the NBU, so we could look at that. None of the high frequency indicators were there also, so that was a big issue. So everyone was pretty much really blind. The way sort of we were approaching is we were looking at mostly at how much territory is being occupied at any given moment, right? And then sort of trying to piece together a potential scenario which we thought would be base case for the year, and then try and go from there to say how much GDP we will be losing. Then once more data came in, such as the destruction of steel plants in Mariupol, we could also account for that. So we basically tried to piece together, the different observations really that we had into a coherent picture. I mean, it was clear that inflation was going to be high, but it wasn't exactly clear, how high, given that, if on the one side you have your consumption is constrained by the war, on the other side you have cost-driven inflation, given the difficulties of logistics and transportation. So that was, I mean, overall really tough, but yeah, I guess if it boils down to it, it's sort of piecing together observations that we had available from pretty much everywhere is the way we went. And of course, once this year the statistics committees finally started publishing data, right, we could go back and actually review what we forecasted. And now we're in a much more traditional scenario. Obviously, we still have the unpredictability of the war. We still have sort of very little clarity as to the risks, right? We know they're there, which are going to materialize, no one really knows. But we do have data for 2022 now, right? And we have some sectoral data, not everything, but a lot more than we had before. Now we can actually analyze and we can forecast in a, I'd say, it's a better scenario. It's still very difficult, all forecasts, the forecast range is huge, right? So I'd say that, a lot of different forecasts have, as long as there's an explanation, right? There are a lot of different scenarios that are possible, right? So that you can see that by looking at the different forecasts. So that is still in place, and I think it's going to stay in place for a long time. Thank you.
Mm-hmm. Perfect. Thank you very much. And like, we're able to develop, brand new like forecasting approaches based on high frequency data that you didn't do like before the war, but able to introduce into your analysis now.
Well, so I mean, we try to, and a lot of people look at like, electricity, right? So electricity consumption was available, right, for up to a point, but then that started being stopped being publishing as well. So we looked at that for a bit. Really, I mean, there's I wouldn't say that we actually had an alternative method that worked, right? So we tried a couple of things, and none of them really gave us any sort of better estimates than just by looking at sort of the war, the way the war is developing, right? So I think the best sort of track that you could go with, in our view, was looking at the territorial gains and losses that Ukraine had throughout the war. I think that gave the best picture for GDP, for example, right? For prices, I mean, yeah, there were still some things that you could track, right? You could look at retail prices, right? So we were doing that. You could look at the different databases that still collected some data. We could look at that as well. So some of the data that was not official was still available. So we used that in combination with the dynamics of the territorial gains.
Perfect. Thank you very much. So, Vitaliy, would you be able to comment if you like shared those struggles as Konstantin did in your like macro analysis and outlook?
Right, absolutely. So those issues and problems were common for every single macroeconomic analyst, and we struggled with the same issues. And of course, we, as Konstantin said, we had to rely on alternative set of data. And I want to give credit for the National Bank of Ukraine and for the Ministry of Economy for providing a very rich and quite accurate data that they collected themselves. So when the statistics committee was not able to collect data from businesses, from households, from municipalities, the NBU and the Ministry of Economy did the job for the statistics committee. So NBU started publishing monthly reports, which were pretty rich in terms of data. So they were sorting internet and trying to scrap prices, information about the labor market. So those monthly reports became kind of a substitute for statistics that is usually published by the statistics committee. Mm-hmm. And of course, if we go back to April and March and February, it was like pulling numbers out of black box. You could only make your best guesses, but none of us had a very good understanding of what was going on with the economy. And only when the Ministry of Economy published its first estimate for the first quarter GDP, it became more or less clear about where economy is heading to and how significant the impact of the war is. At this point, I have to say that the NBU and Ministry of Economy did a great job in terms of providing data that we lack.
That's perfect. Thank you very much. Indeed, the data published by the National Bank of Ukraine and the ministries was very much helpful. And Yurii, let's turn to you, please. We understand that you focus mainly on the fiscal needs of the government. As far as I remember, we've been able to follow the data on the budget on both income and expenditure side during the war. So how was the analytical job on your side?
Yeah, budget forecasting was, of course, quite difficult and maybe even more difficult than macro forecasting. In macro, we rely on the forecasts of our colleagues, for example, from Institute of Economic Research. but still there was a lot of uncertainty last year because of swift changes in taxation. The excises and VAT were dropped, then reintroduced. Different sectors behaved very differently, and also the data from previous years was not reliable for forecasting, not only because of the implications of war, but also because the usual seasonality was impacted by the COVID restrictions. So basically we had to, in our forecasting of budget revenues and financing gap, we had to just go line by line with revenues and adjust them for assumptions relevant to imports, to how the gas extraction and iron ore extraction would behave for the rent, etc., etc. And basically, that was what reiterated Serhiy Marchenko on one of our events, summary events of Center of Economic Strategy last year, that for this year he relies not only on macro forecasts, but also on basically figures of revenues which were from last year, and he tries to be much more like straightforward and down to earth, and we share his approach because this uncertainty doesn't allow to like do it in a classical academic way.
Perfect, thank you very much. So probably let's now look a little bit on our outlook for this year and probably the next year. So as we understand that it's currently, uncertainty still remains pretty high, and we see that forecasts for Ukraine, even for GDP, even for this year, rise quite substantially from negative to positive dynamics. So probably my next question would be, how do you approach like forecasts for this year, say for GDP, for Ukraine, and how optimistic are you with respect to this year's like GDP growth, whether like you're in the camp of the GDP growth this year, or probably you're more conservative? And so Vitaliy, may we start with you please on this?
Right, indeed, there is quite a wide range of projections for GDP for 2023. On the one hand, the range is quite wide. On the other hand, I would say that projections are quite close for each other. It depends on how you look at those numbers. And specific projections definitely depend on assumptions that economists have in mind. So if someone expects the war will continue into 2024 and the current intensity will remain unchanged, so we may end up with one set of projections. So if there is an optimistic expectation that the war may end in like 2 quarters by the end of summer, okay, which is unrealistic in my view, but if you have this optimistic assumption, you will definitely have a better estimate for a better projection for GDP. Blackouts, impact situation and situation in the energy sector. What do you assume for the fourth quarter? Do you expect that Russia will repeat its missile strikes like it did in late 2022, or do you expect that the energy system will keep operating and stay without interruptions? So I guess all those differences are only due to different sets of projections that economists have in their mind. After economy declined by roughly 30%, we are operating at 70% of the pre-war GDP. So I wouldn't say there is a significant difference whether you project that 2023 GDP will be like 69% of the pre-war level or 71% of the pre-war level. It doesn't make much difference in my view. But what I now see is that as we move into 2023, expectations are becoming more and more optimistic. So looks like economy is doing much better than we expected in December or in January at the beginning of the year due to a number of factors. But the result is that there is a gradual improvement in GDP projections for the current year. So my expectation is that the economy will recover only marginally, probably by 2 or 3% this year, and I guess it's going to be a good result. So marginal recovery while the war is still ongoing, marginal recovery when we are still having significant transportation bottlenecks, when we cannot export our metals, iron ore. So marginal recovery is a great result in these circumstances.
Mm-hmm. Thank you very much. So indeed, I would agree that like the final macro outlook would indeed depend a lot on the like particular assumptions you plug into your expectations, like of the active phase or war, or like other like binary factors like resumption of seaborne trade. But like if we will concentrate more like on pure economy, so what like positive drivers you see for local economy for this year? Probably some, if some sectors may like push the growth for this year, and probably some other sectors may lag it instead. Like what's your view on the main drivers for this year?
Well, we can look at the GDP from the demand and supply side. So we can split GDP into demand components and supply side components. So if we look at the demand side, I guess this marginal GDP recovery will be driven by household consumption. So on the supply side, I guess we'll see a recovery across the board, practically across the board. And this recovery is going to be driven by a significant improvement in the safety situation. So the war is still ongoing, but the front is now has been unchanged for many months, and we can definitely say that the safety situation has improved considerably. So many businesses are back to work. Many businesses now have an opportunity to do, I cannot say long-term planning, but mid-term planning. So this is a luxury they did not have back in spring and even in summer. So since there is much more clarity regarding the key macroeconomic indicators, there is a significantly better safety situation. So businesses are just returning to work. They are trying to recover consumption. Some companies restart their capex maintenance programs. So I would say that a better safety situation is a game changer for economy. Coming back to the demand side, I would say that the key risk this year is probably a decline in real government expenditures. So in nominal terms, government expenditures are going to be very close to the level of 2022. But given high inflation, it's very likely that in real terms, expenditures are going to be lower. So government expenditures provided a great support for economy last year. So if not for government expenditures, we could probably have a GDP decline of 40% or more than 40%. So government expenditures played a key, a critical role in supporting economy in 2022. But this year, it's likely that the contribution to GDP is going to be negative, and this is a key risk in my view.
Mm-hmm. Perfect. Thank you very much. Konstantin, would you add your reflections on this question? How optimistic are you about this year outlook, and what are like the main drivers you see currently?
Yeah, sure. I think, I think we are probably some of the more optimistic sort of forecasters on the market. So I think our latest forecast was 5% growth, which is kind of, I think, topping the consensus. And so what we do is what we have adapted is we decided that we will sort of exclude any assumptions on the war, right, from our projections, because obviously, you know, if Ukraine's counteroffensive is really successful, you know, when we reclaim a whole bunch of territory, that's one scenario, right? If it's unfortunately, if it doesn't, you know, materialize in this way, then we have a completely different scenario, right? So if we get attacked by, you know, some additional rockets that Iran ships to Russia, right, that's a different scenario, right? So all of those are, you know, possible, right? And so we decided that we would say, you know, what would the economy look like if we had a status quo, right? If the economy sort of continued to roll out at the pace that it has been rolling out, right? If we look at 4Q numbers, for example, right, and say, all right, what if those numbers, what if that dynamic is sort of maintained, right, throughout the year? And what we see is actually there's not, I would say, you know, there's not that much optimism in terms of sort of the real sector. If you look, so we actually look at the mostly we project the GDP from the supply side, because in my view, demand side forecasting is well, it's not great in Ukraine. It doesn't really give you, you know, sort of hard evidence to base your projections on. So that we don't really love that. And so we look at the sectors, and if you look at the sector, right, what you see is that you know, agriculture is probably going to be down, right? I mean, I think that's kind of the consensus there. We're looking, you know, at industrial production, right? There's probably going to be a little boost there, but most of it is going to be a low base effect, right? And this is kind of what Vitaliy was referring to when he was saying, you know, that the businesses are sort of resuming, you know, production, right? And they are starting to run again. But one big thing sort of to notice here is that there was an extremely low base actually once the war really started, right? So March figures, right, and April figures are super low, and those have not repeated, right? So already we know, looking at the numbers, right, that the economy has been faring a lot better since the beginning of the war, right? And so if we just assume that is already enough, right, to give you a boost based on pretty much, even if you see almost no recovery, right, from 4Q, just saying that, you know, the economy will continue to sort of roll along the same rails, right, that has been rolling on from 4Q, you already got a low base effect, which adds on. The other thing that's also important, and this is, you know, a statistical effect also, is that as Vitaliy actually mentioned, right, the government footprint has actually increased tremendously in GDP. So in terms of its share in GDP, if we exclude education and healthcare, right, where the government is also heavily involved, if you exclude those sectors and just look at, you know, defense and sort of the core government footprint, you will see that in real terms, right, as a share of real GDP, the share has pretty much doubled from 2021 to 2022, right? What does that mean for us, right? That for us, that means that the structure of the GDP has actually changed, right? And that has a statistical effect on GDP growth as well, right? And that, I think a lot of people might be missing that, because it's a technical sort of, it's a technical issue, because what you usually have is, you know, your individual sectors, if you forecast them, they don't actually add up to your whole real GDP number. And that's precisely because your, you know, the structure of your GDP differs from the base year. And this is what we have here. And since government consumption and government production, right, increased so much, we have a really heavy effect from that. So those two things, in my view, you know, are already, if you sort of plug in the numbers and you look at what the numbers tell you, I think they're already saying that even without any sort of big territorial gains, right, or any sort of huge positive scenarios, we're already looking, you know, I think pretty likely we're looking at growth for next year. And actually, the National Bank has just today, and I'm sure Volodymyr will comment on this, right? They upgraded their forecasts for GDP and inflation, actually. And I think that, yeah, it's very much clear, I think, right now, that unless there's a very adverse event, we are likely to be looking at growth. And I would say that it might surprise people, right? What the growth turns out to be.
Perfect, Konstantin, thank you very much. So two housekeeping notes, please, for a moment. So dear audience, should you have any questions, please feel free to add your question into the chat section, and we will address them after the discussion. And also, I would like to welcome Volodymyr Lepushynskyi, Director of Monetary Policy and Economic Analysis Department at National Bank of Ukraine. Volodymyr, thank you very much for joining us today. As a brief recap, we've been discussing challenges for macro analysis and forecasting during the war, and we are currently discussing like current macro outlook for this year. And just to mention that National Bank of Ukraine was very much credited for all the support and all the data bank provided to support macro analysis and forecasting for all of us. And as we've seen, like just earlier today, National Bank of Ukraine has updated its macro outlook for Ukraine for 2023. So if you are like in a position to comment, how optimistic are you with respect to this year's outlook for Ukraine? Thank you.
Yeah, so thank you for inviting me. Yes, actually, yeah, there was a lot of challenges for forecasters, for analysts during this challenging period. So actually, when we were trying to produce the new macro forecast in April last year, it was we are usually performing this forecasting exercise every quarter. We actually produced one for internal use, but we as well communicated some preliminary figures, like the GDP contraction will be by 1/3 during the year, inflation will be above 20%, something like that. And actually, we understood actually that what I said to my colleagues, that under such uncertainty, our task is to create certainty. If there is no we should be a reliable source of information and decrease information asymmetry, because it's information asymmetry is even sometimes worse than direct damage of the war. So, and yeah, we're trying to do these tasks even in times when we have a lack of statistics, but still, I'm pleased that that our forecast, which were made a year ago, was quite close to reality. So on our recent macro forecast, which actually we updated the main figures, we published the main figures today, and it revealed that the economy is performing much better than we assumed 3 months ago in January. The major reason for forecast revision is better situation in energy sector, because it coped with problems in very fast. So it's incredible, but yeah, we didn't expect that, but it's like a fact. So due to this, actually we revised our GDP forecast for this year. In January, we saw it close to 0, but in a positive territory, 0.3. But currently we see it close to 2%. And that revision is mainly due to better performance in the energy sector. And the second reason is actually that the economy is very adaptive to the challenges. It's very resilient, and yeah, and it's one, let's say, second factor of the revision, because even under energy deficit, there was quite significant adaptivity. We revised as well inflation forecast. Previously, we saw like a figure at the end of this year about 90%, 19%. Currently, we see it below 15. So that's quite a significant revision for us. But as well, there were several reasons. One is that the reduction of cost due to better performance of energy sector. There is abundant supply of raw food, which is a good factor. And actually, it's our monetary policy itself, because some appreciation pressure on the cash market actually affects a lot expectations. And you know, when you have a situation where when it's possible for exchange rate to appreciate or depreciate with symmetric probability. It's completely different situation for expectations, and they improved. So that's actually the contribution to reduction of inflation forecast for this year. We are more optimistic on balance of payments situation. We see that there is no such demand for imports, like for energy autonomy, goods, and for fuel. We updated our assumption about the international financial support, which will be higher this year. So that will cover the needs of budget, reduces the risks of deficit monetization by the National Bank. And given all these revisions, actually we end up with a forecast of key policy rate. We previously in January we saw that it could be reduced in the second quarter next year, but currently we think it will be possible in last quarter this year.
Oh, really?
Yeah, so it's like it's integral part of the overall forecast. So, but still, it remains high and will remain high for a quite period of time, because actually we want to have to move to liberalization of restrictions on currency on FX market with a position of strength, with higher key rate, with more attractive hryvnia assets, and that will reduce risks for FX market during this transition to more liberalized FX market.
Perfect, Volodymyr, thank you very much. And just like a short follow-up question on your comments. So in view of like overall like target for FX liberalization, is like flexible FX rate is anywhere or on the horizon at this point?
Currently is not an issue. Of course, we have a like intention to move to more exchange rate flexibility. It's not a floating rate. Of course, it will be some flexibility because National Bank will be, in any case, will control the rate, exchange rate. It will be present on the FX market because there is no way it could balance itself under these circumstances. But for the current situation, the fixed exchange rate is actually, it has more advantages than disadvantages. So, of course, its situation will change over time, and we understand it. But on the current stage, it is so. On FX market liberalization, I mean like reduction of these restrictions which we are having on performing operations with FX. Yeah, that's not like a announce of some change in FX regime.
Great, thank you very much. So now I would like to proceed to our next question. Something Volodymyr has already mentioned is like the fiscal position, the funding needs we will face this year and support Ukraine is going to receive from our donors. So for this question, I would like to pass the floor to Yurii for his overview of this situation. Yurii, the floor is yours. Yurii, you're on mute. Perfect.
Yeah. So just a brief overview on what was foreign financing. These figures were updated as of 19th of April, and we see that basically now the main donors are EU and domestic bonds purchases. and basically also US. And what was the most important, of course, event of the March was the program with IMF, which is front-loaded, which means that we can expect most part of the $15.6 billion which were agreed to be disbursed in the first years, which also relaxes a bit pressure about finding the sources for financing the gap. If we look at the last year, I think many of you know this figure is quite familiar for you. Last year's foreign financing of our budget deficit was very uneven, and sometimes we got very significant amounts, sometimes they were very much below the financing needs, which was one of the main reasons for macro instability in the middle of last year. So I know that Ministry of Finance and other bodies worked a lot to ensure that our partners understand the importance of the stable financing for this year. And we see that as of now, the commitments and disbursement are quite aligned, and this gives more confidence also in macro stability of our country. So as of our estimates, after the recent amendments of the budget, we see that the financing needs could be around 58.4 billion. And this leaves us with a financing gap. Here on the picture, you see 17.2 billion. But now this figure is about 1 billion less because of the sales of bonds, which added another 1 billion almost since the update. So the financing gap as of now remains around like $16 billion. And there is still outstanding question how it will be funded, mostly on the internal market, or we will find other external financing sources, maybe some restructuring of debt repayment for further decreases. And of course, the IMF deal is also important here because it may be a good signal for other donors, lenders, and investors who can provide additional financing. Also, on the side of internal revenues, we made our internal forecast of revenues till the end of the year. And based on the previous conservative assumptions, we saw that the revenues in the budget from VAT, both internal and from domestic VAT and imports, are a bit optimistic. But as we see now that the optimism of business is also increasing. For example, we see that the questionnaire, the assessment which National Bank of Ukraine publishes about the assessment of businesses, where industry and trade for the first time since the beginning of the war are on the positive side of expectations, and even construction rebounded in the March. Probably the expectations of domestic revenues and of imports VAT may be met and will not add to the current estimate of financing gap. And also there are some opportunities in non-tax revenues, especially if the state assets will be managed properly and the nationalized assets. So there is a lot of hope that the additional focus to ARMA, for example, will also contribute to at least a bit higher non-tax revenues that were forecasted. Basically, that's all. Thanks. Nataliia, it's either me or you didn't.
Yeah. Sorry, that was me. Yeah, sorry. Thank you very much for your overview. Like, in your view, do you see like more upside potential or downside potential for the budget deficit for this year?
If there will be no further increases in spending, I see the potential for at least meeting the budget after the updates, or maybe even upside potential for decreasing the deficit.
Perfect. Great, thank you very much. So on this respect, Volodymyr, may we ask to join you to the discussion? How do you see like fiscal needs of government being met this year? Would you agree with Yurii?
Yes, sure, I agree. That's actually very promising signals from our international partners, because that we even upgrade our assumptions about financial support. It's in our forecast, it's above $41 billion for this year. That gives us quite optimistic view on the stock of international reserves at the year end, which we are interested in as a buffer. So it's actually optimistic revision of our forecast. But additionally, I have as well, there could be some positive, let's say, upsides to the forecast. I mean, to the revenues, because we see that economy is performing quite well. There is some efforts to mobilize additional incomes to the budget. So, and additionally, there is a one of the benchmarks in the IMF program is that government will roll over its domestic debt. So in this view, we see like very minor risks for the need of monetization because of the budget deficit by the National Bank. Of course, the environment is quite unpredictable under these circumstances, but it's not, the situation looks quite good in the budget sector.
Mm-hmm. Perfect, thank you very much. Vitaliy, and may I also invite you to the discussion? As you mentioned, you expected lower government expenditures this year to be one of the like downside drivers for the economy growth for this year. So how this like resonates with your thoughts?
Well, I want to emphasize that I was talking about expenditures in real terms. This is what matters for GDP statistics. Of course, in nominal terms, expenditures are going to be comparable to what we saw in 2022. But overall, my impression is very similar to the impressions of Yurii and Volodymyr. I do believe the fiscal sector is well in relatively good shape given the circumstances, and we definitely have to say thank you to our international partners. Apparently, they provide a critical lifeline to the Ukrainian economy, to the Ukrainian budget. And the fact that Ukrainian economy has been stabilized and we have a relatively stable exchange rate, and we have an uninterrupted financing of their key budget areas like healthcare, education, and of course the military. This is thanks to our international partners. And I also want to emphasize that the volume of international aid that Ukraine is receiving, or Ukraine has received since the start of the full-fledged war, is well above of what we expected just 12 months ago. So, of course, the political leadership of Ukraine has done a great job in terms of securing additional loans and grants from foreign governments, from international financial institutions. And thanks to this support, we are able to discuss if economy is going to grow 2 or 4% next year. Of course, without all this international support, Ukrainian economy would be collapsing right now.
Mm-hmm. Great, thank you very much for that. So indeed, the Ukrainian economy is supported to a large extent by this foreign aid we're currently receiving, but we may also try and look at this question from a different little like angle or point of view. So as a result of all these additional loans we are currently able to receive, and taking into account like close to 30% drop in GDP we saw last year, and kind of modest growth expectation overall seen for this year, so we may see the debt to GDP ratios increasing and kind of like making that question a little bit more on agenda. So probably I would invite Konstantin to comment on this. How do you see this situation developing?
I'm sorry. So do you mean debt to GDP?
Yeah.
Or,
yeah. Mm-hmm.
Okay. Well, yeah. So there's going to be an increase. I think our forecast is up to about 90%, right? I think is what we have at the moment. But obviously these estimates, they heavily depend on the exchange rate at the end of the year. And this kind of ties into, I think, sort of the differences in views of whether there is a financing gap at all right now, as compared to, because, I mean, my impression is that the IMF has actually been working very closely with the Ministry of Finance, right, and with donors, right? So they sort of took over, they sort of centralized this effort. As compared to last year, where it was a bit of a sort of haphazardly being put together, right? The G7 countries came together and tried to deliver something. The EU sort of had its own thing to deliver. Now the IMF sort of centralized this effort, and one of the sort of differences, I think, where their scenario might kind of fail, right, is that they are actually assuming they have quite aggressive assumptions with respect to the exchange rate. Right, and that actually dictates both the amount of help you're getting, right, from abroad, right, because you're getting that in dollars, right, and so if you're assuming that the Ukrainian hryvnia is going to devalue, right, you can be covering a larger share of deficit that way than if you were, say, expecting that the exchange rate would not devalue, right, and so that, I think, is sort of the potential to create a gap. And that also ties into your debt versus GDP, right? So depending on what you assume there, right, since a large portion of debt is in dollars, right, and everything we're getting now is in foreign currency, right? That will heavily impact what your assumptions are. So I would say that, on the whole, though, I would say that it doesn't, in my view, look that terrible, right? We're not looking at 150% of GDP, right? We're not looking at something insane yet, right, for this year. That being said, it does seem that we will need a lot of financing, not only this year, right, but going forward as well, right? And that debt will start to accumulate if it remains to be just debt, right? So, and this trajectory that we are sort of being pushed towards, right, of paying for the war eventually, right? Because, I mean, our partners are supporting us, right, but they're not really giving us that many grants, right? They're mostly supporting us through loans, and those loans will eventually need to be repaid, which could be setting us up for sort of a scenario where we'll need to consider some heavy restructuring scenarios, right? Now, I don't think that there should be that much focus on Ukraine's Eurobonds, for example, right? Because going forward, 3 years in, right, we're looking at a gap of some 90 billion, right, that's going to be coming into Ukraine, and that Ukraine will need, right? And so, given that a Eurobond space is not that large, we are also talking about restructuring of not just that, right, but also of this debt that's coming in right now. Because if that is just debt, Ukraine might have a really hard time sort of covering all of that. Yeah, so that's sort of the short view.
Mm-hmm. Perfect. So in your view, probably the next stage of sovereign debt restructuring is pretty much likely and pretty much inevitable.
Well, it's actually a very good question, what will happen to the debt restructuring, because so as I've mentioned, the IMF sort of consolidated the financing effort, but at the same time, it has also sort of taken reins in what it sees as the scenario for restructuring for Ukraine, because the IMF is ultimately interested in getting repaid, right? Because they are a creditor that expects to be repaid, and they are a preferential creditor. So their idea, right, and their sort of preference would be for Ukraine to sort of cut down on commercial financing as much as possible, right? So I think from what I hear and what I see is that the IMF would prefer for really heavy write-offs on commercial debt, right? And we're talking Eurobonds here. but they are not the only party involved, right? So they are there. There's also the donors, right? And the donors have an idea that sort of is simple, and it says that why should Western taxpayers be, paying for Ukraine's sort of reconstruction and the war, right? When investors and the likes of, Goldman Sachs and those guys, right, that have bought Ukrainian Eurobonds at, 20% of par, why should they be making money on this, right? And that's also there, and that's something, that both Ukraine and the IMF, right, have to consider, because that's sort of a view that you have there as well. But on the other side of all of this, right, you also have Ukraine, right, which would not like to see, it's not in Ukraine's interest to see a default, right? Because if things sort of turn sour the way they have with Naftogaz, for example, right, when investors are simply saying no, we are not going to restructure, right, then you are entering a scenario where Ukraine can sort of suggest, right, that a large portion of debt is being cut down, commercial debt, and investors simply do not agree to this, right? And then you're entering into default territory, which would be, it's questionable what that says for the IMF, right? Because repaying debt while at a default to them is possible, right? But that obviously makes inflows much more difficult. But I would say that in Ukraine's sort of interest, that would definitely not be aligned, right? So I think that defaulting on debt and remaining in default on debt post-war would be bad, right? Because that would make investments much more difficult. In addition to this, right, you also have to consider that, and the way investors are looking at it, right? And the Eurobond investors, what they're seeing, right, is that well, if they want, if there's a desire to sort of to cut the face value on them, right, to have heavy haircuts, what they're saying is, hey, look, there's not an equal treatment of creditors here, right? Because on the one side you have Eurobonds, right, which are easy to haircut, but on the other side you have local debt, right, which is not being cut. Right, and it doesn't seem like it will be, because a lot of it is owned by state banks, right? And it doesn't make any sense to default on that, because then you will have to recapitalize your state banks, and it's pretty much a no-go, right? I don't think that anyone is considering that. So if state debt, if local debt is not being restructured, right, then why, and not being haircutted, right? And if the EU is going to get all of its money back, right, and the IMF is going to get all of its money back, why should, commercial creditors, have the short end of the stick, right? So that's also there. And sort of on top of everything, we also have the Russian money, right? For $400 billion, right? That's in one way or another is being sort of frozen abroad. Right? And what we're seeing is that Western countries are not really in a hurry to sort of use that, right? What they're saying is that, well, a lot of laws need to be taken into consideration. This is property of the Russian Federation. We're fighting them, but at the same time, there's not really that much progress, right? So if you look at commercial creditors, they're saying, why should we be paying for it? Russia should pay for it. They're the ones that attacked, right? So let's use their money. So so all in all, it's a very complicated sort of puzzle, right? Where you have a lot of stakeholders, all of them have different views on this. And it's very difficult to say, what the end scenario is going to look like. If I were to bet right now, I would say that there's going to be a haircut on commercial debt, but I don't think it's going to be, super severe, right? So we're saying, maybe like 20-30%, something like that is a possibility, I would say, because the biggest issue here is I don't think investors are going to say, okay, we finance you through the war, now we're happy to take just a 20% cent per dollar cut.
Thank you very much, Yurii. I see you have a question to Konstantin.
That's just small comment about the Russian assets. As far as I understand, as of now, these assets are frozen. But what I heard from recent discussions, my colleague visited, Maria Rybko visited the European Parliament a few days ago, where this was also considered that most of these assets are frozen, but they are not identified. And aside from the legal framework, which is needed, still the Europeans need to find these assets. So this is another piece of cake to address.
No, for sure.
So
So yeah, I agree with that. But I think that one of the reasons they're not identified is that there's not actually enough effort being put into this, right? We don't really see a sort of a concerted effort from the West, right, to say, let's seek out all of those Russian assets, right, and let's create a legislation where we will be able to transfer them to Ukraine or to maybe create a fund from which Ukraine can be reconstructed. We're not actually seeing that political will there yet, right? And maybe this is tied to them sort of, again, one of those things, right? They don't want to escalate. Maybe they don't want to set a precedent of taking away another country's reserves, right? Because that would sort of destabilize sort of the global picture. But either way, they're there, right? And they, while they remain there and being untapped, I think it's going to be difficult to sell to creditors that we are going to, have a huge haircut for you.
I totally agree. And we saw the messages, recent messages from Russian Federation, who hinted that they would nationalize, for example, large Finland investment to energy sector and other investments, which are worth assets of billions of dollars, as a symmetrical answer to any appropriation of assets of Russia in Europe.
Thank you very much. Vitaliy, may we also invite you to this discussion in your view how bad the debt to GDP situation would look like post-war and what the measures would be required to manage the situation?
Well, my expectation is that public debt to GDP will exceed 100% at some point of time. Not this year, probably in midterm over 3-4 year horizon, and just because Ukrainian economy will remain highly reliant on external loans. There is no way to patch the budget gap, but to raise new money from our Western partners, at least for the next 3 or 4 years. On the other hand, the fact that we have high debt to GDP level does not imply that we have significant and immediate liquidity problems, because all the money that Ukraine receives are long-term loans that the country will have to repay in 10, 20, probably 30 years. And I guess our international partners will be ready to extend the maturities of these loans as long as needed. So this high debt to GDP ratio does not transform into liquidity pressures, which is very important, because we have quite a lot of time to sit and think what to do with this high debt to GDP ratio, with this high indebtedness. And also, I think Ukraine will repeat probably the experience of the past couple of years, pre-war couple of years, when the nominal GDP expanded so rapidly that the debt to GDP ratio was shrinking from year to year. And before the war, we ended up with debt to GDP of just 50%. So nominal GDP will definitely grow very, very fast. The key question right now is how much debt Ukraine will need to raise over the next 3-4 years, whether it's nominal GDP or that will grow faster. So I don't see we are going to have a critical problem with high indebtedness. We'll definitely have time, and we definitely have the IMF, which does its debt sustainability analysis and develops and imposes economic reform programs so that our debt to GDP ratio is ultimately normalized and is no longer a threat for economic development.
Vitaliy, thank you very much for that. And before we proceed to our final question, I would like to remind our audience to add your questions to our chat box so we can address them. And now I'd like to shift to our final, I guess, rather optimistic point on your outlook of the investor boom in Ukraine after the victory. It is definitely hard to predict at this point where this moment will materialize, but still we see that economic activity improving already this year as the security situation improves. So should we expect even more optimism after the victory? Konstantin, would you start, please?
Sure. Look, I think that at this point, the wise thing to do, right, is to expect that investment is likely to be coming from sort of the public sector, right, rather than from the commercial creditors or for commercial investment, because that might eventually come. But it's very difficult to say, you know, how attractive Ukraine is going to be post-war, right? Because they're going to be, security risks are likely, again, depending on how the war ends, right? We don't really know that, but it's likely, I think, that security risks are going to be a concern. I also think that, you know, economic stability might be a concern, depending, again, on where debt to GDP ends up being, right? And those talks, I think, are going to take a while. And if we're looking at debt, right, most of which is going to be sort of bilateral and multilateral, right, the likes of, you know, the MFA the EU is doing, right, and hopefully we're going to get more grants, but I think it's unlikely that the share of those is going to be much larger, right? I think systematically something changes. So a lot of the debt is going to be state debt, right? Direct bilateral multilateral debt, and that will need to be managed, right? Expectations on how that is repaid, and if that is repaid, will need to be sort of directed through governments, right? So, and I think that's also going to perhaps be part of the sort of the investment, right? Is when countries sort of say, all right, we gave you debt, right, over the course of the war. Now we're turning, you know, a portion of this debt into grants, right? You don't have to repay a portion of this, right? That's kind of, I think, initially is what we might see. And commercial creditors that tag along will probably want to see we want to see that resolved, right? Because no one really wants to invest into a post-war country which has a huge debt overhang, right, and which is at risk of defaulting, frankly, right, at any certain point in time. So I think that that's going to be the initial sort of push, right? And any commercial creditors that will want to jump on, they will probably, and if we're saying sizable, right, they probably want to partner up or at least go through those channels initially. Now, after that's done, right, and once the debt overhang is fixed, right, or somehow you know, prolonged, or you know, that is sustainable, right, so to say, then I think we can talk about the Ukrainian picture, and you know, the Ukrainian investments attractiveness kind of changing, right, and improving. But along with that, right, we also have to remember that Ukraine has not actually gotten too much investment, right, in the past, even before the war. So the war has demonstrated to the world, right, that Ukraine is capable, right, Ukraine is resilient, right, and there's going to be opportunity, right? Things are going to be destroyed. They already destroyed, right, and it's an entry point. But at the same time, we have to remember that you know, structural problems, right, such as, right, corruption, rule of law, all of that also has to be fixed, right, to at least to a certain degree, if we want to see an inflow of commercial, you know, investment. Something that goes, you know, that's not politically motivated. Something is not where, you know, the government sort of goes out to a large company and says, hey, invest into us, build a plant here, and we're going to give you preferential taxes or something, right? If we want to see real investment flowing in commercially, I think that needs to be changed. So all in all, right, I think public first, then possibly commercial.
Mm-hmm. Konstantin, thank you very much. And probably we may address to answer one of the questions from the Q&A chat. The question was, what sectors would be the best for investments in 2023 and after the war? What are your favorites?
Well, 2023 is hard, right? Because, I mean, there's still a war, right? So Ukraine is, at the moment, right, is sort of a high risk, high return country, super high risk, right? There's a lot of, there are assets that are, I mean, I know that the government is trying to sell some government assets, right, as much as they can, really. And I think some of those might be of interest because a lot of this, there's not that much demand, right? Transactions overall, if we're looking at Ukraine, transactions have pretty much thinned very significantly, right? So even if you were an investor coming into Ukraine and saying, hey, I want to buy something, right? Not many people are willing to sell at really distressed valuations, right? It's kind of similar to what's going on the real estate market, right? Where you go out into Kyiv, for example, right now, right? And you say, all right, I want to buy, I want to buy real estate at half of the price of what it was before the war, right? You're going to end up short-handed, right? Because there's not going to be anyone selling at that, right? And people there will be selling, it'll be a distressed case, right? So I would say that it's more about sort of finding these kind of distressed opportunities, right? Where the supply of sellers, right, is greater than the demand of sellers, right? And we are looking at, for example, the government, right, which has a lot of supply, right? So we have a lot of state assets, and we need to, frankly, sell those to both, give revenue to the budget, right, and to make sure they're working, right? Because right now, any investment, anything that comes into Ukraine and that can inject money into Ukraine is great, right? That increases our chances both for fighting the war and for ending up, with better growth, down the road. So yeah, my idea would be, look at what the government is selling first.
Mm-hmm. Perfect. Thank you. Vitaliy, would you please also comment what are your expectations on post-war investment boom in Ukraine and what the industries or sectors we should focus on? Thank you.
Well, I believe Ukraine will definitely be a hotspot on investors after the war is over, but we have to understand that the post-war euphoria cannot last forever, and this cannot be the only driver of foreign investment into Ukraine. Ukraine will definitely have to do its homework, full-fledged war, and like improvement of investment climate, improvement the rule of law. We have new tasks like FX liberalization, fiscal consolidation.
Vitaliy, I guess the connection is not really good.
Ukraine will have to deal with in order to become attractive for have a great chance to it's better now, right? Mm-hmm.
Yeah. So probably you must switch off the camera so we can hear you better.
Mm-hmm.
Mm-hmm. Mm-hmm. Thank you.
Yeah, I'm just finishing that. We just have to do our best not to lose that chance, because when the war is over, investors will be asking the same questions that they used to ask before the war. So there will be nothing new. We'll be back to the same agenda we had before the war. So there should be no illusions in this regard.
Mm-hmm. Great. Thank you very much for that. Yurii, would you like to jump in on this question?
Yeah, I totally agree what Vitaliy says. We don't see that there will be like investment. I'm very optimistic about Ukrainian economic and general outlook, but not about the investment initially. From the private investment, I guess that we should expect first of all this like impact or angel investment, and pure commercial investment will be limited to some pragmatic opportunities at first in specific industries, in agriculture, in construction maybe. And we really need to take the opportunity and to leave these first pragmatic and impact investors with a good impression, which they can relay further. That's why I would urge everybody to push the government for needed reforms in the judiciary system, in justice in general, in economic crimes investigations, and basically the IMF program, which was published, I think it's one of the successes of the public, of the general public and our society, that we managed to convey the importance of these changes to IMF and also other donors and other international partners such as the EU, who now have this issue also in a greater focus. And we really need to push into this because aside from this like greenfield investment, we understand that the investment to other companies, to businesses who work in Ukraine, it's quite limited, not only because of general issues with the rule of law, but also on with how our Ukrainian business is structured. Like 2/3 of businesses, they really do not have the transparent business models which can be trusted by investors from the outside, and which can see the audited financial statements, etc. So first of all, we need to really take the chance and to quickly change this rule of law environment. And another thing we urgently need after the security situation stabilizes and we will not have this full-blown war, we will need to quickly move to the reform of the taxation system, which is one of the pillars of the current ugly structure of many business models in Ukraine. And if we manage to do both, then there will be this investment boom, but maybe in subsequent years after the war ends.
Perfect. Thank you very much for that. And Volodymyr, probably it's a similar question to you. Do you expect like boom in investments in Ukraine post-war, and what like not necessary preconditions that are like necessary to boost such investments from your point of view? Thank you.
Actually, in our baseline scenario, we don't have some assumptions about Marshall Plan or investment boom. So it's an upside risk to our baseline scenario, not because it's there is low probability of its realization, but because of we just don't know the exact parameters and exact amounts which Ukraine could attract. And additionally, we don't know the timing. Actually, this it's unlikely that there will be some breaking points. So that was war, now it's a peace, and now everything looks differently, and we have a lot of money and a lot of investors queuing to invest in Ukraine. It will be rather a gradual process, and Konstantin is right, I think, about that the public sector will lead this process, and first, let's say, first in the row will be investment actually from our international partners, and some into public sector, probably infrastructure, and then the private investments will follow. So I don't have a different views on what are the preconditions for investment boom. That's the same, like all the structural reforms and all the stuff. So it's all known. So I will not speculate a lot about this.
Great. Thank you very much for that. I guess we now can take a couple of moments to address the questions from the chat we currently have. And Volodymyr, I guess the first question would be for you. The question is regarding FX liberalization. Should we expect the unblocking of dividend payments from Ukraine to foreign investors?
Yeah, I feel the pain. So I completely understand that at some point, actually, all these restrictions are becoming less effective, but more restrictive to economic activity. And so that's why actually in our communications, we are putting the priority on FX market liberalization. So I could not like reveal all the details about the sequencing of which restrictions will be lifted first, but there will definitely be some gradual approach, which we will be moving step by step, and that there is no like calendar plan. There will be a plan based on macroeconomic preconditions to preserve actually the financial stability moving along this liberalization plan. There's only one exact date in this regard is that we need to finish and agree with the IMF the strategy on FX market liberalization, more flexible exchange rate, and moving back to inflation targeting. So that's the benchmark is the deadline for this benchmark is in June. So by that date, we will have the strategy, and we will also somehow communicate how the process will look like.
Mm-hmm. Perfect. Thank you very much. And a small follow-up question. So, while speaking about like liberalization of dividend payments, liberalization for FX foreign debt payments could be also on agenda at some moment, right?
Yeah, sure. Of course, it's needed if you want to attract more like money. You need to pay some money back. So it's logical to to have it in agenda.
Perfect. Thank you very much. We also have another question from the chat. Do you believe Ukraine businesses can compete with CE rivals after the war? I guess we're talking about rivals from Central Eastern Europe. So anybody willing to address this question?
I can say just really quickly. I mean, I think that businesses Ukrainian businesses are already capable of very much competing with the European ones, right? I mean, look at what Europe is doing, right? They're blocking our agricultural exports right now during the war. When on the one side they're helping us, right? On the other side they're saying, "Oh, our farmers are crying because they cannot compete with you," right? So what is this saying? Well, this is saying that Ukraine, yeah, I mean, we're selling, we could be selling at a higher price, right? But at the same time, the agricultural sector is not loss-making Ukraine, right? So we can do it. We have really, especially agro, right? We have really large enterprises. You look at MHP, right? They have been selling their chicken produce to Europe as well, actually, and Europe is now saying, "Oh, we might ban that too." So yeah, we could compete for sure. Not everywhere, right? Because I think in Ukraine, you have to look at sort of real businesses and legacy businesses, right? Where you had someone sort of take over assets, in sort of maybe a shadowy tender, right? Where it was a state asset before, and now you have the rights to it, and now you don't invest in much into it, and it just produces something, and you sort of just milk that, right? That's one business, and that's legitimately that is a business model that we have in Ukraine sometimes. But you also have other businesses which have been really created from the ground up, right? And those can very much do compete already, and I don't doubt that they will continue to do so in the future.
Great, thank you very much. And we have another question, Volodymyr, I guess it's again for you. Would the NBU permit foreign ECAs to receive payments on their financing of Ukrainian projects?
Definitely yes, but at what stage I could not be precise on this. It all depends on preconditions.
Perfect. Thank you very much. So I guess in terms of questions from the Q&A, this is pretty much it. So I would thank very much all our speakers for joining us today, for sharing your thoughts. So in case anyone would like to share any closing statements following our discussion today. Okay.
Yeah, I just wanted to thank you all for the invitation, for a really excellent discussion. It was interesting to listen to it. And it's good that we are much more optimistic than we were in the end of the last year. And I hope this will continue without any black swans, etc. So good luck to everyone. Donate to Ukrainian army.
Great. Yurii, thank you very much. Thank you, Yurii. Thank you, Konstantin. Thank you, Volodymyr. Thank you, Vitaliy, for joining us. Thank you to all our speakers who survived through our intensive discussion. So It was my pleasure to host our event today. So I wish best of luck to all of our speakers and participants, and please stay tuned and join our future events. Thank you very
so
much.
Thank you.
Thank you.